My name is Charlie Becker, and I'm a senior investigator, and I'm going to discuss the next 8 slides. The first slide deals with the fraud triangle. The fraud triangle is a model for explaining the factors that cause someone to commit occupational fraud. It consists of 3 components, which together lead to fraudulent behavior. The first component is pressure. This is a perceived financial need. This is what motivates the crime. Pressures can be caused by outstanding debt, sickness, college tuitions, and vices like gambling and addictions. Once we've gotten the pressure, the next step is the perceived opportunity. This is where a person sees some way to abuse their position with a low risk of getting caught. So some of the ways that contribute to this is managers not managing. This is what we would call our bad tone at the top, or not having good financial practices. Many of the programs that we find have frauds do have good financial practices, but for one reason or another, those practices are not followed. And the third part of the triangle, once we've had the pressure and the opportunity, is the rationalization. Many fraudsters are, particularly in LSC-funded programs, are first-time offenders with no criminal record, and therefore they try to justify the crime to themselves. They will tell themselves it didn't hurt anyone when really it did. It's only a short-term loan, which hardly ever happens. No one ever pays these things back until they get caught. I deserve it. I didn't get the bonus, I didn't get the promotion, and someone else did, and it was really my promotion to get. And everyone else does it. And even though everyone else does it, it doesn't make it right, and it's still a crime. The following sections of this presentation will consist of case studies. In the case studies, we will be presenting details regarding actual investigations conducted by the Office of Inspector General. The case studies will highlight the program areas affected by the particular fraudulent activity. And the case studies will include those involving accounting fraud, time and attendance fraud, payroll fraud, staff travel and reimbursement fraud, revenue stream fraud, credit card fraud and abuse, outside practice, employment and client diversion, question cost, regulatory violations, and conflicts of interest. In the following slide, I will discuss 2 cases involving accounting fraud. The first case involves Benny's missing goods. Benny was a long-term trusted employee. He was a CFO at a program for 30 years. Benny had several vices. He spent a lot of money on gambling and exotic dancers. Benny created a bogus office supply company. The way it worked was Benny and his friend Sonny, who owned a check cashing business, entered into an agreement to sell office supplies to the grantee under the guise of a blanket agreement. Benny would send purchase orders to Sonny's office supply company. Benny would prepare the bogus supply company invoice and had Sonny deliver the invoice to the grantee for payment. And the person he delivered it to, of course, was Benny. Benny approved the invoice and issued a check to Sonny's office supply company. At times, as much as $120,000 in supplies were bought at one time, of which $12,000 was used to actually buy supplies. Benny and Sonny would split the leftovers, usually 90 cents out of every dollar, 75 cents to Benny and 15 cents to Sonny. Benny got the most because it was his idea. With the remaining 10% of the funds, Sonny would buy supplies as needed by the grantee from a known office supply retailer that delivered the supplies to the grantee's offices. Benny then would verify receipt of the supplies as if the program had received 100% of the order, not just 10%. Benny retired, and the fraud was discovered after his retirement, partially because Sonny inquired as to who would be replacing Benny in conducting the scheme. The moral of this story is if you have a partner in crime, maybe you should try to pick someone who's more intelligent than Sonny was. Benny conducted this fraud for over 10 years. He was prosecuted for stealing $1.2 million of LSC funds in 5 years. He stole another 1.2 in the 5 previous years. However, he was not prosecuted for this because of the statute of limitations. Benny was sentenced to 30 months in prison, and Sonny was sentenced to 15 months in prison. The next case is Sherry's Wanderlust. If you haven't realized by now, if you steal money from an LSC-funded program and you get convicted, you get a slide named after you. Sherry was also a long-term trusted employee and family friend of the executive director. She also had financial problems. She had a $100,000 IRS lien placed against her, and she had some gambling problems. She started her fraud by writing fraudulent program checks to herself. She would enter the name of a legitimate vendor in the program's accounting system, but instead of printing the check to the vendor, she would write the check to herself. This went undetected because Sherry would receive the bank statements and destroy any documentation accompanying the bank statements that would show that the checks had been written to her. She also used the program's credit card at a place called Wanda's Bargain Basement. Wanda's was a tobacco, alcohol, and video poker establishment. Sherry would go to Wanda's and get a $300 cash advance on the program's credit card so she could play video poker. This was not enough for her, so the maximum amount of advance she could get in one day was $300, and she needed more. So she, unbeknownst to the executive director, she opened up a debit card on the program's operating account, which allowed her to get an additional $300 cash advance at Wanda's. So on any given day, she would take $600 of the program's fund to play video poker. In addition to this, she set up electronic payments from the program checking account to pay personal credit cards, cable, telephone, and utility bills. She also set up her boyfriend as a program contractor and made fraudulent payments to him when no work was done. Sherry was out of the office when one of the statements arrived and was opened, and this is how her scheme started to unravel. Sherry was responsible for over 500 transactions totaling $195,000 from 2002 to 2008. She was sentenced to 22 months in a federal prison, and when she was sentenced, the judge stated that Sherry not only stole from her program and LSC and the federal government, but from all of the poor people that her program served. The following is a list of some ways that accounting fraud can be prevented. One is by performing monthly bank reconciliations. Second is positive pay. Positive pay is a feature that is offered by many banks. When using this, a program would submit a listing of checks written with payee, amount, and check number to the bank. If all three do not match when the check is negotiated, the bank will not cash the check. The next is separation of duties. In Benny's case, if there would have been a separation of duties, Benny would not have been able to place the order, write the check, and verify that the goods had been received. Reconcile questionable purchases. At any one time, Benny was purchasing $120,000 of purchase of supplies. This is not reasonable and probably should have been looked into. Rotate the IPAs. Many programs have had the same IPAs for 20 years. In both Benny and Sherry's cases, the IPAs were deficient in performing their responsibilities. Ensure that sufficient fiscal oversight is maintained by the executive director and the board, and have at least 1 week of consecutive leave for fiscal staff. This allows other staff to understand and perform the duties of the folks that are on leave, and also would have properly prevented the issues that arrive with Benny and Sherry. And also have a strong whistleblower policy. If someone sees something, they should feel comfortable to say something to management regarding a possible problem. Now I'm going to discuss some cases involving payroll fraud. The first payroll fraud case involved identity theft. The payroll clerk knew that certain staff worked on an intermittent basis and that on any given pay period they would claim no hours. She would identify the staff who had not worked any hours, knowing they would not be expecting a paycheck. She changed those employees' direct deposit information to hers in the payroll system and then entered hours worked for those employees. Once the payment was made to the payroll clerk's bank account, she changed the direct deposit information back to the employee's legitimate information. The payroll clerk was arrested in the program's lobby for stealing from her previous employer. When we investigated her activity at the program, we identified approximately $10,000 in fraudulent deposits that had gone into her bank account. She was also arrested for this and prosecuted and convicted. The second case involves padded pay. This is a situation where an individual had complete control over the payroll system with no management oversight. The employee was in a management position and should not have been eligible for overtime. However, she classified herself improperly in order to get overtime. In addition to padding her overtime, she claimed hours that she had not worked and was not even in the office, and she charged numerous overtime hours for time she spent on making payments to payday loans. These are personal payday loans with whom she had debts, and probably should not have been spending her time doing this instead of doing the program's accounting work. The following are some actions that can be taken to help prevent payroll fraud. Ensure that supervisor approval of all timesheets, and make sure that once a supervisor approves the timesheets, they cannot be changed. Require advance approval of hours outside the normal work week. This includes overtime, weekend time, before and after hours, and telework. Require notification to the payroll administrator and to the employee when direct deposit information is changed. In the identity theft case, the program had the opportunity to do this, but they never invoked this option with their payroll provider. Reconcile timesheets to payroll, and also compare work activity, such as calendars, emails, case files, to payroll dates and hours to make sure that they both agree.